All right, part two of the plug and play stock portfolios is dividends. This will go a little quicker as there won't be quite as many explanations. But again, we want companies that the buy and holder could own for several years. And that means it has to be relatively close to its buy zone. And I'm going to add these buy zones throughout the course of the day. Most of the charts are done. And again, with all of these companies, we're looking for something that the market doesn't value fully. 3M, they got beat up for a number of reasons. I just think they're a good company in general. And with the new need for healthcare supplies, they are one of the fourth industrial revolution leaders that we've talked about in the past and should do well. Analog Devices just had a merger that's going to do very well with them. Maxim was a company he merged with. AT&T, we know all about Warner. They're in the buy zone right now. Broadcom has been one of the fastest growers of their dividend asset-light company. Brookfield Renewable on the right side of history should have a C Corp soon. CenturyLink has the third biggest fiber backbone in the country, fourth or fifth in the world. They are going to get bought at some point, I think, and they still pay a pretty fat dividend, and their revenues are starting to rebound. Cisco, we all know them, big leader. Their balance sheet is so good that I see them continuing. It would be one of the few companies in the next several years that is able to continue to buy back shares and pay an increasing dividend. Illinois Toolworks. Let's take a look at these guys. Illinois Toolworks, somebody new that I'm introducing. I know a lot of you know who they are. But this is a stock that can go on some pretty major tears and has been on one for a decade, right? So you want to buy these guys as a winner on the pullbacks. What does a pullback look like for these guys? Hard to find them, right? That's how good they are. Well, next year when there's stimulus to rebuild the world and get us out of what I contend is essentially a depression, they're going to be a major beneficiary of that. Company has been managed well, a couple of good mergers, a couple of good divestitures. Came almost down to 618 again. Oldest extension is always pink. Oldest retracement line is always green. The newer retracement line will be blue. Oops, it didn't love me. And then the extension line from here to here to the bottom. Now, question we have to ask with many of these stocks, is the recent extension, right, the March bottom, a legitimate bottom? The answer is twofold. No, it's not legitimate because a lot of these companies should have gone down to levels down here, but the Fed stepped in. Well, is the Fed going to unstep in? Right? They are not going to unstep in, right? The Fed's going to keep their nose in things. So this gap from here to here, right, from here to here, unless we have the Armageddon scenario, I don't see it happening, right? So we take this, kind of want to be able to see that line at least. That's not that important. It's never going to get down there unless the company collapses. Where are the buy zones on this guy? A whole bunch of lines right here. right in here. But I think this 618, that one, right, these levels here, I do think we probably see them approach their lows again. I don't think that I want to buy them above this 0.5 line, but I think we can, for the aggressive people, for the cup is always half full, we can take this 618 level and probably make that the start of the buy zone. And I've been going out to November 1st of 2021 just for seasonality purposes. And because of the lack of vaccine so far and what I've told you I think is going to happen with the mRNA and the DNA, I just don't think that those are going to be permanent solutions. And I think the market reacts negatively when it finally realizes that the broad-based vaccine isn't until the second half of next year. And one of the companies that I'm going to show you is a company that I think is the leader in that. But I think that as far as Illinois Toolworks goes, they're going to do well with stimulus. So somewhere in this area, probably going to want to buy them. That would represent a pretty long-term sideways, right? If you bought it down here, this yellow box, that goes all the way back to when? Start of the Trump presidency. So if you can buy down in here, you basically got 4 years of chop and then massive stimulus coming out of it. Kinder Morgan, we've talked about a lot. Home Depot, you all know about. Lam Research, Semiconductors, Lockheed Martin. Merck is the one that I think is the dark horse and the favorite all at the same time in the coronavirus vaccine. I trust them. I think that their last two mergers have been great. And I don't think that you're overpaying much for them. And they pay a fat dividend. So this is the company I want. I think Dave Zanoni agrees with me on this one. I think Merck is a company I want in pharma. And then you package them in by selling some puts or owning some biotech or owning a biotech fund. I think you're in pretty good shape. Newmont Mining, S&P 500 company, one of the biggest increasers of their dividend among any companies. So they're a genuine dividend growth company. Like I told you, as the price of gold goes up and as it stays in a stably higher range, they drop all kinds of money to the bottom line. They can pay down debt. They can buy back shares. They can pay out a dividend. Those are all the things that shareholder yield is composed of. Shareholder yield is reducing debt, reducing share count, paying out a dividend. And these guys are a shareholder yield diamond in the rough, right? Or gold in the rough. Nutrien, Canadian company, I think it's a must own because the farmers are gaming the system right now. They're not using as much fertilizer because the insurance program for crops is so good this year. So they planted to qualify for the crop insurance program, but then they didn't fertilize because they don't care. So one way or another, the crops grow and they get paid, or the crops don't grow and they get paid. So why outlay the fertilizer money? Well, Nutrien in the fertilizer industry has taken this as an opportunity to reduce production and supply. And I would think that probably within 2 years, you see most of these fertilizer companies really having huge rallies. Northrop Grumman, another of the defense contractors that I like. Aerospace. Qualcomm, the whole 5G revolution, and the intersection of IoT and AI. Their patents are dynamite. They pay a big dividend. Raytheon, another in that group, along with Lockheed Martin, Northrop Grumman, and Raytheon Technologies. You know, the thing to keep in mind with these three companies is that there's some overlap, but they all have other businesses. Lockheed Martin is going to be a big deal in water. Northrop Grumman, multiple businesses, including healthcare and tech. Same thing with Raytheon. So these businesses, can't think of them as only defense or only aerospace. Like Ford, which I talked about in the growth portion of the growth webinar, like Ford, these companies all have multiple avenues of business, and they are all fourth industrial revolution leaders. I mentioned fourth industrial revolution in passing over and over because we spent a lot of time on it. I'll write an article about it to really explain what that means, but it is the intersection of AI with machine learning and the ability of companies to transition and just do what's needed, right? It makes them, even though they have heavy assets, it makes them more like an asset-light company because they can control a lot more of their costs and they can pivot to the more profitable things when they need to. Starbucks, go to a Starbucks drive-thru and tell me what you think. Starbucks is probably the best food store, restaurant, I guess, or restaurant in the country. I think they're better than McDonald's. I think they're better than Chipotle. I don't think that there's anybody that can hold a candle to Starbucks. I think Starbucks is in a league of their own. They've done the right thing with food, right? They have the keto friendly and the carb friendly, and they still have all your bakery. Starbucks, you know, the locations they're building around me are in the right spots. I know one of the architects, local architects for them. I'll tell you, I can't find anything wrong with Starbucks. I try. I can't find anything wrong with them. And people are addicted to it. Store Capital, I think that they are hands down the safest way to be in REITs. And it's because of the footprint of their properties and the type of leases and the ease with which they can refill their spaces if something bad happened. And I think that's the thing that people don't think about with real estate. They just bid up the dividend. You know, these guys essentially own boxes and strip malls. It's so easy to knock those down and rebuild and sell the land if you need to. Refill them if a store goes out. I keep looking at REITs, and I've looked at 60 or 70 of them by now over the last year. I don't see any company out there that really is as good as Store Capital from debt structure. I mean, you go through the entire crossing the T's, dotting the I's checklist. They've got it all. And I think that as the malls redevelop into being, I think, shared corporate campuses with services and some shopping, I think they become mixed use sort of. I think they'll build apartments attached to them or condos attached to them like they have already started to do. These types of strip malls and boxes, I think, lead the way, right? Until we figure out how we're going to deal with, you know, how do we want to shop in 5 or 10 years? Is everything going to go online? Well, if it does, these end up becoming kind of like lily pads for inventory. So I just don't see where they can lose. They're easy, they can transition with whatever happens. Buffett is a big holder. I think that's real. The news from Intel this week is that they're thinking about contracting out some of their semiconductor work. Taiwan Semiconductor, I talked about years ago when nobody loved it. It's a stock that I think you have to buy in the pullbacks, right? You know, I told people that I wanted to be in Alibaba, even though I don't like Chinese stocks. So this is irrational, right? That's irrational. But this box here is pretty rational. So if we go back to 5-year chart, it hits the 200-week moving average in 2015. I'm going to call this a bear market, that sideways move. We can even go to here. So as I've told you, I think that the market is keying off of the Trump election. Right, you can make it smaller, do all sorts of things. But I think that this is a more true pivot. It's Taiwan, it's not America. You say, okay. And clearly these guys are going to benefit from the move away from China. One thing to keep in mind, Taiwan is a flashpoint country. We're not going to let Taiwan go back to China. Just telling you now, it's not going to happen. So that's, I think, something to maybe be a little afraid of. But I think it also gives us volatility. So it's getting right up here. It's overbought, starting to show a divergence. I think it's probably going to turn around real soon. I don't even know if we need to do the most recent extension, but we can. Here, and then here. I don't know how important that is. It doesn't seem to be very important to me. I think we can key off the longer time frames if we want to. I think that that's probably the right thing to do, actually. But we'll put these in just for frame of reference. Try to get these lines to match up. There you go. Where is your buy box? I mean, look at that huge. I mean, from here, that's a whole lot of support, right? That looks like it's an area where it had a little bit of fight. What if Intel gives Taiwan Semiconductor some of its work? Whoa. I guess you could be really aggressive and you could go here, right? So I guess you could buy it if it goes under 60. I'm more inclined to buy it in the 40s, but you can do this. Again, study the company, learn what they do, spend some time on it, treat it like a book report, and you'll come out okay. So Disney, I put these in alphabetical order, not of the company, not the symbol. So Disney's on the bottom. They just barely make the list. It's kind of weird. They have a 1.51 dividend. I measured from 1.5% up. So all these stocks, dividends over 1.5%. If you take a look at their growth rate, their dividend growth rate using stock rollover, you see that the dividend growth rates are all pretty darn good. A lot of these have low betas, right? Low volatility relative to the market. Which is what a lot of retirees want. 44, 60, 59. All right, let's say 59. Again, we have to use the technical signals at the time, right? So once you're in the buy zone, and that's the alerts, right? The alerts I have, they're already in there for the ETFs. I'm going to put the top end of the buy zone into the alert system with margin of safety investing. Everybody else, if you're at fundamental trends, will have to copy it, but I'm looking for a plugin that does alerts. But really, you just copy into your own alert system at your brokerage, the top end. And when you get the alert, you say, okay, I've taken the time to study this company or this company. Now let's take a look at the technical signals to see where the pivot's going to be. It's like 90% of the time these boxes are right. I mean, it really is that high. We give ourselves some margin of error, and then we have to do it in real time with the technical signals. All right. So Intel did do a contract with Taiwan Semiconductors yesterday. All right. So we're gonna have to wait for a significant pullback here, because even though that's a great contract for them, does it justify straight up? Right? They're already down 618 on the retrace. I bet you get it in the upper 50s. I bet you do. I don't know if you get it in the lower 40s. Again, if you're more value oriented, you want to buy the bottom of these buy zones. If you're more growth oriented, you want to buy the top of the buy zones. You always want to apply the technical indicators, right? So this comes down to in here, that's probably where you need to buy. Doesn't necessarily going to go, right? Super strong stocks don't necessarily get completely oversold. They just get less overbought. And then they kind of get in the middle. So if they get to the bottom middle, right, below 50, down to 30, you have to think about buying if you really want the stock and the valuation is right for you. All right, so why don't we take any questions here real quick? Any of these stocks jump out at you, something you want to know? No. Somebody mentions that CenturyLink has a larger. Yeah, I was just talking about fiber. I know that their fiber is like third biggest, but yeah, you're right. Because of the merger a couple of years ago, yeah, they rank number one in a lot of different things. So I still think CenturyLink, their assets are so valuable, somebody's got to buy them. Right? That company gets broken up in some sort of strategic transaction with a merger and acquisition, something. I don't know how it works, but something. They're going to unlock value there somehow because they have an asset that is so valuable and so irreplaceable that somebody's just going to have to buy it. To me, Google, when they're forced to start, spitting out the baby Googles, to me, Google, Fiber, and CenturyLink make a lot of sense together. We'll see who else is out there. Dish, but I don't think they have the money. Google has, more money than the government probably at this point. So they just can't print it. They have to earn it. Government can print money. Google has to earn it. Well, yeah, there's a lot of good takeaways here. I mean, I think all of these companies are great. I tried to get these lists down to 20. I think they're both 22. And then we have the QQQ stocks. I did not include Apple, Microsoft, Amazon, or Alphabet in any of these lists. Why? Because QQQ is a big holding for a lot of people, right? So you have to consider how much you should own. So if all four of these stocks are roughly, 10-ish% in QQQ, depending on which company is the bigger trillion-dollar company at the time, that means that if QQQ is 20% of your portfolio and Alphabet's 2% or 10% of QQQ, you multiply the 20% you have in QQQ times 10% of it is Google. That means that you already have a 2% exposure to Google in your portfolio. And that's not bad. I mean, these are some of the only stocks that I would say you can have a double position in. So when I scale in, I often start with a 0.5%, kind of a mini position, or I'll start with a 1% starter position. Then if it goes down or an uptrend starts, right? If I can get a lower price or a new uptrend starts, not just volatility, I'll bump it up to 2. And then most of the stocks, I'll get it up to 4 at some point, or I'll sell a put that might get me to 4, right? Very few stocks you want to have 8% exposure to. I think these are for the stocks that you could have 8% exposure to. And then every now and then there's a growth stock that's going through the roof for you, right? But in general, those 2 to 4% positions are normal if you are also owning ETFs. Now, if you're one of these people who thinks that you're going to try to manage 50, 60, 70 stocks, God bless you. And if you don't think you want to use ETFs, okay. I'm not going to argue. I'm just going to tell you that I do this full time. I use multiple systems, and I have multiple other analysts that I talk with, and we kind of think tank it. None of us manage portfolios more than 30 or 40 stocks anymore. It's just too hard. Even with spreadsheets and artificial intelligence and everything else, stick with your best ideas that happen to be the right prices when you have money, and then fill out your portfolio with 25, 50% ETFs, somewhere in that range. You know, I think of things in quarters on the big picture, and all the way down to sixths and eighths and twelfths on the at the micro level. And then I convert it into percentages. You will have noticed that I think of stocks in these percentages, but I think of ETFs as 1, 3, 6, and 12. Why is that? Because a really good stock portfolio is generally not going to have more than 25 stocks. The very best stock portfolios out there from the best managers are 20, 25 stocks. That's what they have. They're the conviction picks. If they need diversification through treasuries or an index, they just buy the treasury or the index. Now, our job is to buy the better indexes. Weight our portfolio to the best stuff. Give ourselves enough diversification so that we can't get blown up in a correlated move. Hence the gold, really. So, and now I'm looking at cryptocurrencies because I think there is going to be a consumer role for crypto, and a peer-to-peer and a business-to-business role for crypto. We have to figure out which ones work. The consumer cryptocurrency, it looks like Bitcoin is going to be the survivor, but we'll see. We have to wrestle control of Bitcoin away from the Chinese, and that's been an expensive endeavor so far. And the developers are going to have to figure out a way of splitting it, you know, like 1,000 for one split. It doesn't make sense to have, you know, think of it like an asset. Ultimately, cryptocurrency is a hedge against currencies. It's not a substitute for equities or even for bonds. It is a way to have some of your savings in something that might not get devalued as much. That's ultimately what it has to become for it to exist long term. If it gets traded like a gambling asset, then that's what it is, a gambling asset, and eventually it busts out like everything else that's gambling, right? There's nobody that wins at gambling, just other than the house, which is why we are option sellers, not option buyers in most cases. So let's take a break, then we'll talk options.